Welcome to the Rational Edge.
Today, we're doing a deep dive into something that's really the financial backbone of almost every major company.
We're talking about property, plant, and equipment, PTE.
Exactly.
And when most people, they look at a balance sheet and see a new $500,000 piece of equipment, they just instinctively see a huge cost, a drain on cash. But the rational edge here is to see that asset completely differently. We need to shift your perspective. In finance, that machine is actually an unexpired cost.
Right. Or you could call it prepaid power. It's capital that really represents future competitiveness.
So our mission today is to give you that strategic understanding. We want to show you how that asset's value is calculated, how it's managed, and how it gets consumed over its life.
We're going to track its entire life cycle, guided by some really foundational accounting standards. The rules that govern measurement and depreciation.
Yeah, we're basically charting the asset's full journey, and we've broken it down into 3 stages. First, we're going to tackle the price tag. So figuring out the initial true auditable cost.
Step 1.
Then we move into the working years. This is all about the critical allocation of that cost over time, using depreciation as a strategic lever.
And finally,
we'll look at the tune-up. This is where we have to figure out if spending more money on the asset is just simple maintenance or a game-changing capital investment.
Great. So let's unpack that starting point, the price tag.
Right.
The core accounting rule is that PPE, so tangible assets used for more than one period, they have to be recorded at cost.
But cost, in this context, it's so much broader than just the number you see on the invoice.
That's the critical part.
The real strategic principle here is what we call total cost of ownership, or TCO, and it all happens on day one.
Right. The cost has to include all normal and reasonable expenditures that are necessary to get the asset not just delivered,
but in place and ready for its intended use. That's the line in the sand, isn't it? The thing auditors really look for.
It is. Let's take that Type A Tech Solutions AI production module from our sources. The invoice price was $500,000.
Okay.
But that machine is totally useless sitting in a crate. So you have to immediately capitalize things like taxes, freight to get it to your factory, and insurance while it's in transit.
And the preparation costs, those can be huge. If that $500,000 machine needs, say, a specialized concrete foundation, or you had to bring in electricians for special high-voltage hookups, those costs, maybe another $20,000 for installation, they get bundled right into the asset's value.
Exactly. So if the initial cost was $500,000 and we add, say, $15,000 for freight and another $25,000 for installation and testing,
then the total capitalized cost for that asset is actually $540,000.
And that higher number becomes your starting line for depreciation.
Okay, so here's where it gets nuanced, and I know this is a huge focus for audits. What if, as part of that $25,000 in installation costs, $5,000 was for integrating new control software?
Okay.
And another $5,000 was for training the staff to actually run the machine.
That is a fundamental distinction, a really important one. The software integration costs are capitalized.
Because they're necessary to get the machine ready for its intended use. It can't function without it.
Precisely. But that $5,000 for staff training, that's an expense. It hits your income statement immediately.
Why the difference?
Because the training benefits the people, not the machine itself. It doesn't meet that physical ready-for-use criteria.
So that one distinction software is capital, training is expense, shows how granular TCO gets.
And auditors will use digital invoices, deployment logs, everything, to make sure companies aren't improperly stuffing operating expenses into their assets to make the balance sheet look better.
We also need to distinguish between different types of property, right? Like a building versus land.
Yes. For a building, you'd capitalize costs like materials, labor, and overhead during the construction, plus things like design fees and permits. It's pretty straightforward.
But land is where the accounting gets a little counterintuitive.
It really does. Land has an indefinite life. It's not consumed. So its cost includes everything to make it usable: surveying, clearing, grading, all that.
And here's the part that I think always surprises people.
The demolition costs.
Yeah. If you buy a piece of property just for the land, but it has some old, unwanted building on it, the entire cost of tearing that building down,
minus any money you get from selling scrap metal or salvage materials.
that cost is actually added to the land account.
Right. So tearing something down is treated as an investment in the land.
That feels so backward.
It does, but it follows the ready for intended use principle perfectly. Your intention was to use the bare land. The demolition was just a necessary cost to get it to that state, so it's capitalized and never ever depreciated.
And you have to contrast that with land improvement.
Exactly. Things like paving a parking lot or installing fences and lighting.
Those do have a limited useful life.
And because they do, those costs must be depreciated. It's crucial to keep land and land improvements in separate accounts on the balance sheet.
Okay, one last puzzle piece for initial cost, the lump sum purchase. Let's say our studio bought this land and building together for $100,000, but separate appraisals came in at $80,000 for the building and $60,000 for the land.
So a total appraised value of $140,000.
Right. You can't just split the purchase price 50-50.
No, you have to allocate the cost based on the relative market value. You figure out what percentage of the total appraised value each asset represents, and then apply those same percentages to your actual $100,000 purchase price.
Which ensures the depreciable asset, the building gets a fair share of the cost.
Okay, so now we have our accurate cost. We have our starting point. Now we have to track the asset through its working years.
And this is the depreciation process.
Now let's be absolutely clear on this. Depreciation is purely an accounting process to allocate cost.
It is not, and this is so important, it is not a mechanism for measuring a drop in market value.
Exactly. You're just systematically spreading that initial TCO over the periods when the asset is helping you generate revenue.
To do that, we need three things. The cost, which we just figured out.
Then the residual value, an estimate of what you can sell it for at the very end.
And finally, its useful life, which is how long the company intends to use it, not necessarily how long it could physically last.
Right. And the choice of which depreciation method to use. This is where management gets a really significant strategic edge.
It turns accounting into a lever for managing profits and planning taxes.
The first method, the most common one, is straight line.
The standard bearer for stability.
It is. You just take the depreciable cost, which is cost minus residual value, and divide it by the useful life. It charges the same amount to expense every single year. Very predictable.
And investors tend to like that predictability.
They do. Then we have units of production, or UOP. This is becoming much more relevant with, data-driven manufacturing.
Instead of time, you're allocating cost based on actual usage.
Miles, machine hours, number of widgets produced. It's the absolute best way to match expenses with revenue, especially if your usage varies a lot from year to year.
Our sources called this the IoT method, the Internet of Things. When your smart factory machines are feeding real-time usage data directly into your accounting system, UOP becomes incredibly precise.
It does. And finally, we have the accelerated approach, double declining balance,
Oh, yeah.
DDB.
This one front-loads the depreciation expense.
It does. You take the straight line rate, you double it, and then you multiply that doubled rate by the asset's current carrying amount at the start of the period.
And this is the strategic choice for, say, high-tech companies.
Right, absolutely. Or any industry facing rapid obsolescence. That huge early expense creates a very large, very immediate tax shield.
It preserves cash flow right now.
Which allows a startup, for instance, to pour that cash back into R&D, which is often way more important than reporting slightly higher stable earnings in the first couple of years.
Let's make that choice really clear with the numbers from the Taipei Tech AI module.
Okay, so $500,000 cost, $50,000 residual value, and a 5-year life. That's a depreciable cost of $450,000.
Under straight line, it's easy. It's a steady $90,000 of expense every single year.
Predictable. Now, under DDB, the straight line rate is 20%. 100% divided by 5 years. So the DDB rate is 40%.
Okay.
In year one, 40% of the full $500,000 cost is $200,000 in expense.
Wow, that's $110,000 more depreciation than straight line.
And that translates directly into a much larger tax deduction and more cash preserved in the business. It's a massive strategic difference, and it's based purely on an accounting choice.
Which leads us to the critical audit trap here. Regardless of the method you choose, depreciation must stop when the asset's carrying amount hits that residual value.
You can never, ever depreciate an asset below its estimated salvage value.
So there's a final year adjustment you have to make.
There is. Using that DDB example, by the start of year 5, the book value might be down to, say, $64,800, but we know it has to end the year at exactly $50,000.
So you don't take the full 40%.
No, you only record $14,800 as depreciation expense, just enough to hit the target. It's a mandatory final adjustment.
And what if, based on new data, you realize the asset is going to last 7 years instead of 5? Do you have to go back and fix the old reports?
Never. We treat a change like that as a change in an accounting estimate. We just use the new updated figures to calculate depreciation from today moving forward.
So past reports stay as they were.
Right. It ensures historical reports remain reliable while still reflecting the new operational reality.
Okay, so the machine is running, we're allocating its cost, but things inevitably need upgrades or they wear out. This brings us to the final challenge: classifying spending after the asset is in use.
And this decision, do we expense it now or capitalize it and expense it later, is absolutely critical to a company's reported profit.
We split this into two main buckets. The first is revenue expenditures.
These are your ordinary maintenance and repairs, the things needed to keep the asset in its normal operating condition.
So routine cleaning, oil changes, standard tune-ups.
Exactly. And these are recorded as an expense on the current income statement. They immediately reduce your profit.
Like our Adidas example, routine repairs are just expensed as they happen. It's all about maintaining brand consistency.
Right. And on the other side, you have capital expenditures. These are the major investments, the big upgrades.
And to be capital expenditure, it has to meet one of three criteria.
It has to either extend the asset's useful life, increase its capacity, or significantly improve the quality or efficiency of its output.
This is what fuels brand evolution.
It is. Let's use a modern example. If you replace a broken part with an identical new part, that's a repair. That's a revenue expenditure.
It's expensive.
But if you replace that broken part with a new high-efficiency AI chip that doubles the machine's output and cuts energy use.
That's a capital expenditure.
Yeah.
You're making the asset fundamentally better.
Correct. And that cost for the new chip gets added to the asset's book value on the balance sheet. It doesn't hit the income statement all at once. It gets expensed slowly through depreciation over the asset's remaining life.
And this distinction is what can separate, honest management from outright fraud.
It's the heart of the WorldCom scandal. They intentionally misclassified billions in ordinary operating costs.
Things that should have been immediate expenses.
And they capitalized them. They called them assets. It falsely inflated their balance sheet and created billions in fake profit for years.
So for an auditor, it's not about the dollar amount on the invoice. It's about the nature of the work.
Did it just keep the machine running as usual? That's an expense. Or did it make the asset better, faster, or last longer? That's when you capitalize.
Looking back then, the whole life cycle makes sense. The initial cost sets the starting point.
The choice of depreciation charts the journey.
And classifying those later expenditures determines the company's financial health and stamina.
Which brings us to our final challenge for you. We want you to think like a CEO making a really high-stakes decision.
So imagine you're the CEO of a tech startup. You just invested heavily in a new AI platform. Inflation is high, which is squeezing your cash.
And you know this tech could be obsolete in 3 years, not the 5 you originally planned for.
You need maximum cash preservation right now.
So which depreciation method do you choose? Do you go with straight line to present stable, predictable profits to your investors and keep your asset values high on paper?
Or do you choose double declining balance, which creates that huge immediate tax shield in year one, preserving that critical cash flow to fund R&D and just navigate the crazy pace of technological change?
It's a strategic choice, and it really defines your priorities as a manager.
We've covered the asset journey from the price tag to the tune-up. Next time, we're going to dive into what happens at the end of an asset's life. We'll cover disposal, the unique world of natural resources, and how to value a company's most mysterious property, intangible assets.
Thank you for listening. See you next time.